following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Welcome back to NinjaTrader Live. I'll be your host for this segment, Tom Schneider, CMT with NinjaTrader. Traders Workshop, we like to bring in our NinjaTrader ecosystem partners. And today is no different. One of the original guests on Traders Workshop, proud to and happy to bring back co-founder of SpotGamma, Brent Kochuba. Brent, how are you today?
I'm doing very well. Thank you for having me on. It's been an exciting week in markets generally, but especially in the volatility space. So yeah, happy to dig into all that.
Yeah. I mean, when we've been talking about volatility in the markets, and it's been kind of quiet, for how many months, right? And then since you were last on, everything went haywire, as Jim Cagnita would say. So just in the back of my mind, I'm like, oh, Brent's got to have some great visuals. But options expiration, we like to pick your brain a little bit and see, what's happening. And I know you just have so much to show. One thing, though, I have a question about, and it's really what Mike Burke was saying in the last segment, is kind of the importance. Where does July expiration, August expiration fit in kind of in the grand calendar, right? We know that June, September, December, March are all big options expiration months, but is there any kind of peccadillos that happen with these inter months with their options expiration?
Yeah, I mean, what was interesting about July OPEX was the market high was the night of VIX expiration. So VIX expiration is on a Wednesday morning. Incidentally, it's next Wednesday in this case, but it was the Wednesday before options expiration, and the market low or the market high really started at VIX expiration Wednesday morning, which happens at 9:30, and the market just dropped precipitously from there. Into Friday OPEX in July, we got a little bounce, and then we were just kind of, down we went for the remainder of July. So that OPEX, that VIX expiration in particular, really seemed to kind of pull a plug or pull a pin rather, that allowed the market to really, come back quite a bit. And what we find in this expiration, which is quite interesting, is that it's a pretty small expiration, and it's actually very well balanced now. You would think there'd be a lot more puts relative to calls because of the market behavior over the last few days, or weeks rather, but it's actually pretty neutral, and that's because a lot of people closed up put positions, and that, they monetize those puts because there's such high volatility. We got the market to bounce here a little bit, and now it's about waiting and seeing, what data is going to come out, right? PPI this morning, CPI, retail sales, options expiration Friday, VIX expiration next week, Jackson Hole, NVIDIA earnings. I mean, it's just a crazy slew of things coming up. And so I think that data matters a little bit more than the size of this particular expiration.
Okay, fair point. When you talk about that put call ratio, or that, those put positions were taken off, that was really due to the drop back, beginning of last week, right? When market, had 3 really bearish days, and that kind of rebalanced maybe that ratio.
Yeah, that's right. And I actually have some interesting slides on this, if I could put this into context a little bit. Yeah, let's show some of this. Excellent questions here, and you sort of forecast some of the charts I want to show. So this was VIX expiration in July. Right, and you could see that VIX expiration literally marked the high, and then we've really careened lower once these calls really got pulled away, short VIX positions got pulled away. But if you remember into last options expiration, there was all these bizarre correlations, right? Like correlation as a trade kind of was hitting all-time lows, measurements of correlation. We had that incredible IWM outperformance that had come at the expense of the Mag 7s and all that. We had some of the tightest breadth we've ever had, meaning only 3 stocks were 20 to 25% of the NASDAQ or the S&P, so that breadth was very narrow. Realized vol, which is here, so how much the market had been moving. The S&P had hit multi-year lows. This is the correlation chart here, but I wanted to go to this. This is the equity put call ratio. And what you can see here is that, indeed we were at, multi-year lows. I mean, 2021 and meme mania was a little bit of the extreme, obviously, which is what you could see in here. But, we were at lows, right? It's a call dominated environment back then. And then I think if I scroll forward a few charts here, you should see the breakdown of it now. Sorry, there's so many charts to go through these days. Here we go. This is from Deutsche Bank. This is actually not the ratio, but this is call volume minus put volume. As per last week, this came from Deutsche Bank. What you can see is that calls minus puts, we just went full on puts, right? In the single stock space. And so we literally went from, hey, all we want to trade is calls to, oh my gosh, everything's about puts. And that makes sense because implied vol gets so high that either you want to cash in hedges that you have on, or you want to think about selling puts in some of those cases where you think vol is a little too high. Additionally, when vol spikes like that and the VIX gets to 50, that means calls are expensive as well. So call buying in those situations is not always a great idea because those options prices are just very high. And so, there's a natural tendency of people to shift to puts in those regimes anyways.
Okay. So, thinking about, the put call ratio, you have that chart up, kind of call heavy now at lows. In my mind, put call ratio to me was always kind of crazy because it's reverse of how we think. We go long, we buy calls, but you were doing puts over calls. So, I'm thinking of the flipping it, right? So really we're looking at like 2-to-1. That ratio is 2-to-1 calls roughly, right? Am I correct in that, or is it?
Yeah, I think that's about right. Where we were before. I think that's about right. Yeah. And on the single stock side, you tend to historically get more calls trading than puts. Whereas on the index side of things, you'll get actually the opposite. And the reason is because most people are long a bunch of equities and then they buy S&P puts to hedge their portfolio, right? Whereas on the single stock side, you usually get people buying calls as a generalization because they want to use those calls to, try to catch a rally in NVIDIA or, whatever stock they're trading.
Right. You mentioned NVIDIA earnings next week, right?
Yeah. So one of the key things I think here was if you just dial back or think about the correlation trade that we talked a lot about, the correlation trade was explicitly in the option space. It was people betting against owning like NVIDIA calls, really NVIDIA options, sort of being long NVIDIA vols, the way we'd state it, but buying NVIDIA calls versus selling S&P calls, right? And so what that did was, that's a type of correlation trade. And in options universe, people would play the Mag 7s or the semis or these names that were performing really well, and they would buy those options and they would sell the S&P. And so what you got was single stock volatility being very high and S&P volatility being very low, right? There was this imbalance. And that is embodied in this correlation metric, which is the blue line. But this correlation, as a trade was also showing in other forms, right? People piling into the semi stocks, to chase performance rather than owning a broader set of the S&P, right? So, what sector you own mattered, right? In terms of performance so much. And the only way that correlation really unwinds is when markets crash. So here you can see during the COVID crash, correlation ripped, right? Because everybody sold all stocks. They wanted to get out of stocks because, we were shutting the world down. And so you can see at the same time, VIX spikes, right? Because that VIX spikes when the market crashes.
Right.
So in this scenario, what we saw was a couple of interesting things. We saw the IWMs start to catch a bid right before options expiration. And if you remember, all of a sudden IWMs are catching a bid and then we're up a bunch while the S&P and the Qs were down. So you got inverse correlation there. It's weird to see IWMs up sustained, moving higher while Qs and S&P are moving down. So the correlation started to shake or spasm was the way that we put it. And so What I catch now, what I think is so interesting is in regards to your NVIDIA question, we're at this interesting point where in April we had a similar spasm. If you remember, we had a real big kind of spike in correlation. The S&P was down 5% in April, and while the NVIDIA was down 20% over that same period, right? And then coming out of April, all of a sudden NVIDIA rallies back, as does the S&P, and then we were just going on about our business. We have sort of a similar setup right here, right now, where market's been weak. We're down 5% from those July highs. But and NVIDIA earnings are coming up on the 27th. And so on one level, you go, hey, if NVIDIA pulls out, huge earnings like they've been doing, well, then shouldn't everyone just pile back into those AI stocks and we get the same behavior that dominated this year, right? But my problem with that is that the rate market is now different, right? We're pricing in, and I have this. I have a chart of this. Most people are probably aware of this already. But there's a 100%. The market is pricing in 100% odds of a rate cut in September, and it's split 50-50 between whether we get a 50 bips rate cut or a 25 bips rate cut. So the whole year up into this point was people were thinking maybe sometime out next year we'll get some rate cuts. I don't know. It's like this sort of like thing that was in the future but wasn't. Right here, right now. And so we're all pretty comfortable with expectations around rates and markets, right? Well, now you have the situation that we're going to get a rate cut, which I think is going to start to turn people's attention to not an allocation inside of equities, like do I need to buy NVIDIA versus, industrials because that's going to perform much better? But the question is, do I need to own equities or do I move to bonds, or am I trying to lock down 5% yield in some product that I could still get it? Or the reason we're cutting 50 bips is because now there's a recession. I mean, Home Depot's numbers today obviously weren't very good. Market's shrugging that off at the moment, but it's just an interesting difference in the macro environment now versus in April when we kind of last had this real big spasm.
Well, and Brent, to that point, we've been talking about rotation. I think we were talking about rotation a month ago, right? When you were talking about that IWM versus spiders and NASDAQ. And now it's kind of back off, right? That rotation, we're looking to be outside of that. But with that rate cut, I won't say guarantee, but almost guaranteed. There's this idea that who benefits, right?
Yeah.
And who benefits most, bonds, and in terms of stock index futures, small caps benefit more than large caps. And so, you're right, it is different from April, because April, we were thinking of 6 rate cuts. They just haven't started yet. They're just waiting for the data. Let's go.
Right.
But until we saw the data, you couldn't make that commitment. Now we're starting to see that data that, yeah, they're good. They're probably going to cut in September, barring anything catastrophic. So, it's really rubber meets the road with this earnings call. And was that earnings call in April that big of a miss? Was it a slight miss and the market panicked, or was it a pretty big miss for earnings? I don't recall.
No. I think NVIDIA earnings were fine. What's tended to happen with NVIDIA is it rips into earnings because everyone kind of has the expectation, and then earnings come out and is like, okay, great, they hit the home run we all thought they would, and then like
let's
the
get
game
out.
goes on, right? It's like, oh, Steph Curry's shooting a 3, like we know it's going in, like let's
right.
Move along with our day. So the trigger was CPI came in a little hot in April. And then suddenly, we may not get this rate cut we were hoping on, and that really started to shake things. And then there was a geopolitical flare-up as well, obviously, in April too. So, it didn't take much to shake this foundation and unwind a trade that, based on all the metrics we've been talking about, the record low correlation and very narrow breadth, and the VIX had a beta of 0 to the S&P per Nomura, which essentially mean that the VIX had no longer any link to the S&P basically at all, right? Like, okay, S&P is moving, but the VIX is just not even linked to it whatsoever, which is bizarre because the VIX is literally priced from S&P options, right? So there was all these anomalies that had, shown up, and we could flag the anomalies and knew that that stuff had to get unwound, but what was the trigger going to be? The funny saying, of course, is, well, no one had the yen on their bingo card, but that seemed to be the little trigger to get, hey, vol cover, correlation started to unwind violently and all that stuff. And, so if you look at where correlation is right now, and this is the SIBO correlation metric, there's people who look at all sorts of different correlation metrics. This is just an easy one to look at. We're still pretty, fairly at the low end of the range, I guess I would say, in terms of correlation, right? Like we're not, it's not like we hit COVID level, correlation, meaning that everything really stuck together. It's kind of like, we kind of like got an initial short cover, right? And I think when you look at this trade or you look at the volatility space, some people definitely got their hands slapped last weekend in terms of being short the VIX, let's just say, or short vol. And there was some margin calls there, but a lot of people use that opportunity to enter back into these trades in a way, right? Like, let me short the VIX and play mean reversion, for example.
Right.
And I think that, we haven't washed out or totally cleared out all these positions. And I suspect that we're gonna move to clearing these positions out, which would mean kind of like another leg down in markets. And on the same point, if you look at, it's kind of funny, this is the the 60-40 portfolio died in 2022, right, when they started to raise rates, and so both bonds and stocks went down. But this past week, if you were long just TLTs, which is the long bond ETF, versus long spiders, well, your performance actually netted out pretty good. So it's kind of funny where now suddenly your rates are going to get cut because of a recession or whatever else is going on. And then you go, oh, that's funny. My spiders lost 4% over this time period, but I was totally hedged out by my bonds. And it's kind of like, great, 60-40 portfolios back, which just sort of speaks, and I don't know how this plays out in the future, but it just sort of speaks to this, rotation or different, trade maybe that the market starts to look at, meaning, am I in equities versus bonds or cash or something like that versus, hey, like I got to own AI versus like, some other basket of stocks.
Well, and to that point, you had a quick inversion, I guess, of the yield curve. 2s and 10s for a hot second were back to normal, right? Where the 2-year yield was less than the 10-year, I want to say, for a day, right? And that was as a result of that market crash, if you will, last week, and then resumed back to normal, where we've got 2 years yield to about, I don't know, 3 basis points, 4 basis points higher. So, but getting closer, right? And so I think, that yield curve back to normal gets us back to more of a normal 60-40 kind of behavior or environment.
Yeah. And we're bleeding into the macro space, I guess, which is not my specialty, but I do agree with you in terms of, the rate situation is a little bit strange and unknown, and the recession and won't we get this recession? What that brings back for me is volatility. So what we're looking at here is term structure for the S&P, and essentially the higher this green line is, the higher, more volatility people are pricing in the future. So the x-axis here is expirations, and so you can see here's where NVIDIA is set to report, and we have OPEX and all these short-term data points that are important here. We lose a little bit of volatility because PPI was okay today. CPI, I'm sure it's just going to be an inline number tomorrow, and then we get retail sales on Thursday. So you're knocking down all these data points, which give people more information, which when people know what's coming, they expect lower volatility generally. Right. But the big date ahead is Jackson Hole, which is next week. And so I don't think that implied vol can really drop all the way. So right now we're kind of like, I haven't checked recently, but we're at VIX 20 this morning, right? And so elevated vol is likely to stay through FOMC. And the idea here is that when vol comes down or the VIX comes down, it helps to push the market up. We refer to this as sort of a Vanna flow in markets. And so we have Jackson Hole coming up, but then immediately we're going to turn towards, obviously, NVIDIA earnings, which will be another big data point. And then you have the actual FOMC in mid-September. And then we have the election, obviously, coming up after that. So, there are these rolling, pretty big macro events coming up that I think is really going to prevent volatility from going back to where it was in early July, right? Like it's going to be hard for us to return to that normal because this focus is on all of these macro data points, which I think are very difficult to forecast, right? Rates 50 or 25 bips, are we in a recession or not? Is it going to be Trump or Kamala? Like there's very little certainty now, in addition to whatever's going on in the Middle East, which, if missiles start flying, hopefully that doesn't happen, then immediately it's a big risk off trade, by itself. So there is this kind of wall of worry that is hard to resolve.
Yeah, and I think you could even throw back in the mix Ukraine and Russia, right? Ukraine had an incursion into Russia for the first time, I think, maybe the entire conflict, and that caused a response by Putin. So you're right. It's, I think, two fronts now back on geopolitically. It just an interesting time, right? Throwing that election year, as you mentioned, I can see volatility staying up, and that's not, volatility at 20 still seems to me pretty low historically. We're just so used to these I shouldn't say single digits, lower teens for so long. Even in a time where we just didn't know when the rate cuts were happening, it seems just strange to me.
Yeah, and if a VIX of 16 implies 1% daily moves in the S&P 500, and I think that's a reasonable expectation for where we are now and probably going forward over the next couple of weeks. And I think, just looking back over what happened, last week, it highlighted this idea that, a lot of the stability in markets is something of a mirage, I think. We have these flows that come in and there are sort of auto-correlated, meaning that, hey, the last 5 days were very calm, so I'm going to bet on another calm market today. And so I'm going to have all these high frequency day trading and depth of book will be pretty thick and, everything looks good. And then the minute there's any volatility, then all of that evaporates, right? To that point here, this is U.S. equity liquidity, they call it. This is a Goldman chart, but what it really is E-mini top of book liquidity. And it, as you can see here, it evaporated on Monday. And that's at a time when volume, was very high, right? There's margin calls and forced trading, and everyone just wants to adjust their books because of all the movement. And so, the second that volatility rears its head, the bids and offers go away, the markets widen out, and, there's just this chasm of liquidity. And so we saw this in, obviously, the futures market. You could see here, this relates to the VIX going to 65. If you really want to nerd out and start looking at that, part of the reason the VIX, did it really hit 65 or not? Well, that's just a function of bids and offers in the options market widening way out. There's some people that think the zero DT market broke because it was a very low zero DT options day. A lot of the brokerages were unable to open for some reason, right? So you couldn't even necessarily get access to trade. And I think that is going to be not necessarily brokerage is not opening, but the lack of liquidity, I think, is going to be a real feature of, future market drawdowns, because there's so much short dated derivative based flow that can turn off, in a heartbeat, and everything is so electronified now and so, can react instantaneously that, 1 minute you're feeling great about things and the next minute you can't get a fill, right? And I think that's a real concern now, when we look at, trouble going forward in markets.
Well, and you mentioned those there were electronic platforms that just didn't work that day, right? On that Monday, and that was mostly in the stock market, correct? Is that what you're referring to?
Yeah, like you couldn't log into, there was, I think, a half a dozen different brokers that,
right,
that were just down. So, not necessarily the trading platforms like NinjaTrader, but you want to log into your, Schwab account or something, like we just couldn't do it. So
and
that's
more
there.
of a technology thing than a market thing, right? But it still reflects in here because that liquidity, if you can't trade, you can't trade.
Yeah, if you can't trade, you can't trade. And so, I think I have that zero DT chart here. So this was the zero DT volume that I'm referring to. We had 25-ish% zero DT volume in the SPX on that day, which is obviously, this is a half day, I believe it was here, mid to late December. So, it was very unusual. And I think a lot of this reason was because, okay, markets were very wide and vol was high. So that changes the economics of trading 0DT on that day. Plus, people tend to want to trade longer dated when vol spikes. But also, the retail community, a lot of them just couldn't log in to do anything.
Right.
And I think that's an important measure or important thing to consider when you're maybe betting on a market crash. Like, you assume that if you short the market, you're going to be able to cover that trade, right? But might be a little more difficult. Yeah.
Real quick, in the quick few seconds, I'd love to see that 1% or 2% move chart. I know that
absolutely.
you pioneered that, and would love to see that what it looks like now, because it must look so different.
I didn't update it for the actual crash. I stopped updating it when it actually broke. Where did we go here? So I think we had the second highest number of days ever outside of the Great Financial Crisis. Obviously, that 2% chart has now ended. We did beat Volmageddon. What's interesting is we still haven't had a 2% one-day rally. So the last time we had a 2% one-day rally was in February with NVIDIA earnings. And so, if you take that day out, we still haven't had that big 2% rally higher. And so that's an interesting idea. And I would just frame up the market real quick for those watching. There's a lot of what we call positive gamma above 5,400 right now. So 5,400 to 5,450 is a big resistance zone, I think, into Friday. And if we break 5,300 to the downside at any point, then I think we're going to see a pretty big vol spike and a real downdraft really rather quickly, because there's still a lot of risk that's lurking, and traders are still a little skittish. So those are the two zones of how I'm looking at things over the next couple of days.
And still a lot of movement Thursday and Monday, maybe not so much on Friday, but with news, who knows?
Yeah, that's right. It's not a huge expiration. It's pretty balanced, so there's not much to really grab on. I love saying, hey, OPEX is a hugely important thing. I'll be first to do that. But this one, I just don't really see that, particularly Jackson Hole coming up on Saturday, I guess it is, right? So there's, this is more of a macro thing to watch right now. But if we do break that 5,300 area, that's negative gamma down there. We should see the VIX really start to move up. And I think it would downdraft to the 5,200 level, like in a single day or two. It would happen pretty quick.
Wow. Okay. Brent, where can people find you? They want to learn more.
Thanks for that. SpotGamma.com. You can find me. If you go to SpotGamma.com/OPEX, we have an OPEX spreadsheet. We're doing a couple of behind the scenes webinars around OPEX over the next couple of days. So please join for that. And then I'm at SpotGamma on Twitter as well.
Thanks so much, Brent, for joining us. It's always a pleasure to have you on. And, enjoy the next couple of weeks in summer as it winds down, and we'll see you definitely in September.
Awesome. Thanks so much for the opportunity, and great seeing you guys.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.